For more than a year, all we heard is that we were entering a gold and silver bull market as we watched prices take us for a ride on the volatility roller coaster. Silver and gold investors have to choose what role volatility will play, as we should expect prices to fluctuate during 2023. You must ignore the hype, as gold and silver prices do not go straight up or straight down. This video will show you exactly how I managed market volatility in 2022 so that you can use it to profit in 2023. 2022 was rough, as gold investors and silver bugs waited all year for prices to move, which they did. It just wasn't always positive price movements. In fact, in some ways, it's easier to describe 2022 like a roller coaster ride. Let's call gold prices the Gold-O-Matic roller coaster. First, we had the Gold-O-Matic roller coaster starting the year off at 1804 and then quickly accelerating to $2,074 on March 8th before quickly pushing our stomachs into our throats by dropping all year until we hit bottom in November around 1629. Meanwhile, the silver bullet roller coaster peaked at 2638, only to bottom at 1785 2 months earlier than gold. This is a great analogy for precious metals because roller coaster rides are all about volatility, meaning quickly moving your body from one place to another in order to create excitement. The problem for us stackers is we didn't know we were signed up for a roller coaster ride. I think many of us expect this to be more of a Ferris wheel ride, slow and steady increases with time to enjoy the view. Well, we didn't get that. You all know my mantra, focus on the conditions, not the predictions. Well, the other part of that for me is also dealing in probabilities, not possibilities, which leads me to believe 2023 will be even more volatile. In this video, I'm going to do something most people don't do. I'm going to pull back the curtain on my purchases in 2022 to show you how I use volatility to help me grow my stack by using less money. First things first, as investors, volatility is one of those things that we just have to find comfort in the discomfort volatility creates, especially its impact on us emotionally. Again, you have to find comfort in the discomfort that volatility creates. We've discussed the importance of managing our emotions, and it is truly a critical skill set for us as investors. Often we think about managing our emotions when it comes to FOMO and not chasing prices up, but it also plays itself out when it comes to falling prices, where instead of chasing prices up, it usually scares people out of the market as the prices go down. In fact, we saw a lot of people give up on metals a couple of times last year as volatility had them feeling like a kid who'd eaten too much junk food before getting on a roller coaster ride. You know that ain't good. One of the major issues is that people tend to associate volatility with risk. They are not the same thing, folks. Going back to the roller coaster analogy, what you experience is volatility. But as long as everyone has done their job safely and correctly, there's no risk in the roller coaster ride. Too often, investors conflate these two issues and treat them as the same. In my last video, I spent time refreshing our brains on the conditions that lead us to believe that metals are poised to perform well. That is extremely important because as we experience volatility, it's the understanding of the conditions that allow us to stand firm on our investment thesis. As long as these positive conditions remain in place, then these wild price swings are volatility and not risk. When you understand that, then you can start to see volatility for the opportunity it presents for savvy investors. Now, if the conditions around your investment thesis change, well, then you do have to consider that there may be some risk wrapped up in that volatility. As Rick Rule warns, volatility is not a bad thing if you're prepared for it, but you as investors and speculators absolutely need to be prepared for it. I want you to think about buying a really nice winter coat, and let's say you pay $100 for it, and a week later, it goes on sale for $70. Is that jacket suddenly riskier to buy, or is it just a better deal? Well, as long as it's still wintertime cold and you can use it, that sounds like you're getting a great deal on something that you bought at a higher price. Or maybe it's an opportunity to get another one in a different color. So when gold dropped $400 from $2,000 to $1,600, that needed to make you excited, not fearful. The challenge is knowing how to change your stacking strategy to benefit from the volatility. Well, there's a lot of ways to do this, but I'm going to show you how I navigated it in 2022. On the screen is a chart of my purchases in 2022. On the y-axis, that's the gold prices. On the x-axis, those are the dates that I actually made purchases. And then the blue line in the middle represents gold's daily price. What I want you to see is that I made purchases on a total of 21 days last year. Not all purchases were the same amount, but it's hard to add up what I bought and chart that. Plus, y'all don't need to be in all my business like that. but I will give you some good insights. Plus, I did videos during these times documenting how much I was buying. So if you really want to know, you can go back and play investigator and look at those videos. When you look at this chart, I hope the first thing you notice is how I didn't make any purchases from March 28th when gold was $18.94 to July 28th when gold was $17.59. Next, I want you to notice the price pattern for gold. Hopefully you can see what chartists call the 1, 2, 3, 4, 5 ABC pattern as shown in this slide. What I'm showing you is the Elliott wave theory, and you don't need to become a technician. You just need to get the general principle. In a bull market, you typically see these patterns, this 1, and then a pullback on 2, then up on 3, and then down on 4, and up on 5. And then we have what is called a corrective wave that we usually refer to as ABC. And then the price continues upward. The same is true for a down market, like in this slide. The same pattern, just a different direction. And if you don't fully grasp this, don't worry, that's not the point of this video. If nothing else, I just want you to notice price peaks from January to March, right? And that they tended to go higher. And then after that, look at the peaks. They tended to be lower, or as you hear people say, lower highs and lower lows. Not good. My purchases tended to coincide with lows in the price pattern. You could just say that it's luck, but as I just showed you, it's all a pattern. This is why I say to you, there's always another trade, or wait for the pullback. How do I know there's going to be a pullback? Because there's always a pullback. Next, let's quickly go through my year, and I want to point out a few things. This year started off, 2022, I made a few purchases because gold was doing pretty well, and then it shot up because of the war. But gold is already trending higher. So I felt like, okay, I can stay here a little bit and see where it goes because it was already on an upward move. I had no idea that it was going to give back all those gains. However, in March and April, it was clear that the market turned around. And if you were following Stackers at that time, I did several videos about how I was sitting out the market, that we needed to start stacking cash now and not try to catch a falling knife in gold prices. I even did a controversial video where I told you that dollar cost averaging is a terrible strategy in a downtrending market. And I still stand by that. My logic is, why buy as it's falling when I can keep my cash, let the market hit bottom, and buy more for cheaper? So I stopped buying at around 1900, and I was able to re-enter the market at 1759 almost 3 months later, $140 cheaper, and with 3 months of buying cash stored up. I want you to notice then that how prices appeared to bottom in July, but it didn't right away. But then prices increased. And with that increase, I said, okay, well, maybe we're at the bottom. And then I jumped back in on a pullback. And during that time, I picked up around 6 more ounces. And then gold failed to hit a higher high. Basically, the price rolled over and started to go back down. So I waited. Then it went lower, and I waited for a buying opportunity, and then I got back in and I made some purchases. And then prices jumped back up at the end of September. So what did I do? I waited for a pullback. And then I went in and I bought even more because it was clear at that time that we had actually hit the bottom there. Then when prices took off in November, I did the same thing. I waited for a pullback and I bought. And ultimately during September and October, I picked up 11 ounces between 1640 and 1750. Now, I hope you know me by now, and you know that this isn't about bragging or even lightweight bragging. It's about showing you how you can do the same thing if you invest in your learning. Often I find that people talk to you about how to do these things, but they don't show you how they did it. And then it's just this abstract learning opportunity, or maybe lost opportunity is better said. What do I want you to walk away with during these times of high volatility? 1, sometimes the best thing you can do during volatility is wait for it, nothing at all. Sit there and be patient. Sit back and let the market declare what it plans to do. You heard me say that in multiple videos during that time. I didn't know which way the market was going to go. I was just going to sit back and let the market declare itself, and then I was going to make my decision. Just because you have money doesn't mean you need to go buying at that moment. Stack that money up as cash. It's okay. We are not drunken sailors on leave that need to go out and get all wild and spend our money. Number 2, very similar to number 1 in doing nothing, but it's also being patient, controlling your emotions, controlling yourself, and saying, there's a price movement here. I'm just going to wait for the pullback because there's always a pullback. 3, you don't need to time the market, but you do need to listen to and learn how to listen to the market. Understand the way that markets move. Again, some people might say that I'm timing the market, but I disagree. I mean, how could I happen to buy at all those low points if I was timing the market? I'm not that lucky. What I was doing was looking at the price charts and the movements and saying, oh, it goes 1, 2, 3, 4, 5, A, B, C, and it's really simple. 4, remember, there's always a pullback and another buying opportunity. And 5, remind yourself of your investment thesis and make sure the conditions haven't changed. Those are the 5 things you can really do in a volatile market, is really manage yourself and be patient and understand ways markets work. I clearly don't have a crystal ball, but I don't think that just because the calendar turned to 2023, the market said, I'm going to leave all that volatility nonsense back in 2022. Absolutely not. Volatility is something that has to get worked out of the system. So expect this year to continue to be volatile. Expect the first month or two to be very exciting as prices move positively, and then we're really going to see where the economy is. And I expect metals to grind sideways and maybe even downwards a little through the summer until we get to August, like in 2022, and then it's going to take off. But what do I really know? What I do know is that I'm going to focus on the conditions and watch the price movements, because those are the only definites we have. In the comments section, what do you think of this idea of the Elliott wave and the price patterns? Have you noticed how these price patterns have played themselves out in markets before, now that you've seen it? How do you handle volatility? Is it just easier for you to stick with dollar cost averaging instead of trying to worry about counting waves on the price chart? Is waves theory something you'd like for me to cover more? Thank you for being my A+ students. Always stack smarter and never stop learning.